Welcome back to another episode, and today we're going to be talking about how to prepare your finances when you're planning to buy your first home in Scotland. So, the first thing that you want to be doing is knowing and understanding your budget. So, how to work your budget out and be realistic to avoid overextending your finances. So, how I would do this is I would be reviewing your current spending, review your income, review your outgoings and take away anything that's not a contractual commitment. See anything that you've got on there, like your Just Eat payments, gym memberships, anything that you could potentially stop when you move into your new home. I would take that away from your outgoing. So I wouldn't add it in. And then what I would look to do is I would take what you're earning and I would take your committed expenditure. So the things that must stay there when you buy your new home, I would then factor in the additional running costs of the property. So these will be things like your gas and electric payments, your council tax payments, if you're planning to get TV packages, broadband, anything at all that you're going to have to be paying on a monthly basis, and I would factor that in. What I would also do at the end of every month when you're doing this, I would make sure that you're leaving yourself with some disposable income just to factor in what would happen if you were if inflation was to kick in and things were to go up the way, what would happen if the energy prices were to double in price, all of these kind of things, and make sure that you've got enough funds there to cover that if that was to happen. Once you've done that and you've considered your budget and you've got an understanding as to how much you can afford to spend on the mortgage, what you also need to be considering is what options for the mortgages that you're going to be looking at. So would you be looking to take on some form of fixed payment, which means that your mortgage is guaranteed not to change for a period of time? This is fairly popular generally with first-time buyers. Or are you happy to take a chance on it and go for what's known as a variable rate? So these can be lender variable rates or tracker rates, and these can change. These can go up or down in line with whoever's in control of them. So let's use the tracker rate, for example. The tracker rate tracks against the Bank of England base rate. So if the Bank of England base rate goes up the way, your monthly payments would go up the way as well. And because of that instability and that there's no guarantee with it, that's why the fixed rates are proven to be a popular option with first-time buyers. Once you've got all of that sorted out, if you've already got your deposit sitting there, great. If not, you should be considering what you're going to do to build up your funds. So you're going to be using a gift from a family, or you're going to be saving. There's a cracking episode that I've done on this recently that goes through lots of different options for deposits. So don't forget to check that out if you are looking to see what your options are going to be. But you should be considering at this stage how you're going to finance the property, and not just the deposit to buy it. You need to be factoring in other things like moving costs and legal costs and those kind of things as well. Anything like land tax. So factor in all of these kind of things to your upfront costs. Don't just save the amount that you need for your deposit, because there would be additional costs on top of that. And what I would also do is, before committing to applying for a mortgage, I would review your spending habits. So for example, if you're doing a lot of online gambling, how's that going to look if an underwriter is going to be making a decision if you're spending 20% of your income on gambling? So have a think about these kind of things. How will your purchases impact your finances? So for example, if you are living at home with your parents and you don't have any savings, you're spending every penny that you've got every month on things like Just Eat, cinemas, days out, and you don't have any savings, and then now that you're deciding to buy a house, you're going to try and start saving quickly. Underwriters will take a viewpoint in that, because what that means is it means that you're spending every penny that you're earning before you've got the financial commitments that you would have when you own a house. So start thinking about the future, even if it's a year or 2 years down the line, even if you're only saving a little bit, then take that into consideration. And as I say, don't forget to check out the previous episode that I did on deposits. If you are at least a year away from saving, then you should certainly be considering the lifetime ISA. And don't forget to get professional advice. Use an advisor such as a mortgage broker or a mortgage advisor to help through the journey, and get a trusted solicitor in place as well, and they'll be able to give you the costs for their service. But I hope you did find this useful. As always, if you did, don't forget to give it a like and please subscribe. Cheers.